Of the major U.S. equity indexes, the Russell 2000 has been the clear underperformer since putting in its post-election high on November 25th. The index subsequently went into a corrective phase, losing 14% of its value by the last day of February. For comparison on that, the NASDAQ was essentially steady over the same period. But what's the problem with the Russell? Well, in order to pinpoint the fundamental reasons for the decline, it's best to start with why it rallied aggressively in the first place. The belief was that new policy initiatives, particularly tariffs, would disproportionately hurt big multinationals and benefit the smaller domestic companies that are in the Russell. Although those policy initiatives still exist, perhaps they were fully priced into the Russell at its highs in November? Well, back in November, there was also a belief that the Fed was lowering rates, but that the overall economy was still doing quite well, and that the rate move was just supposed to get us back to a neutral level. Now that narrative has flipped, as the Fed is still supposed to be easing, but the Atlanta Fed GDP now has collapsed to a negative 1.4%, suggesting the possibility of a recession is growing. The development makes the future of the Russell a bit cloudy. At the same time, the Russell responds well to lower rates, but it's also very sensitive to the trajectory of the domestic economy. The perfect mix in November was lower rates and a better economy with lower inflation. Now that story is morphed into only slightly lower rates because of a resurgence of inflation coupled with a slowing economy, a mix that the small caps does not seem to like.